Welcome to Wealth and Means. Advice dressed up like hard work.
Today's episode is stacked. We start with what you didn't see in the news, where open source quantum computing, flash radiotherapy, ARM's push toward desktop class performance, AI agent testing, search volatility, smart glasses privacy, drone defense microcaps, Substack sports strategy, and even viral jacket potatoes start to look less like isolated curiosities and more like early signals of where infrastructure, attention, and trust are quietly shifting. Then we go to Wake Up Ready, mapping the week ahead through CPI, income and spending, NVIDIA's GTC, the Fed, the Bank of Japan, Treasury pressure, credit tightness, and oil risk. After that comes Knowledge Bomb, where ancient scripture meets modern portfolio theory through diversification, liquidity, and the old wisdom of tying your camel. Then Humor Me, where lucent surrender and Veridread capture the strange confidence game of AI-era authority. From there, it's the greater debate, a clash over leverage, speculation, and whether margin is a ladder for growth or a fuse for collapse. And finally, let's invent again with Otto Wichterle, a kitchen table prototype, and the insight that the inventions that win are often the ones that remove the most friction. Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. There's a quiet pattern that shows up every week if you step back from the headlines. Beneath the big stories, wars, elections, market swings, there's a second layer of signals. It's what you didn't see in the news. Smaller things, technical threads, niche product launches, weird consumer trends. Individually, they don't dominate the front page. Together, they tell you where systems are bending. First up, the idea that quantum computing might become open source. An organization called Open Quantum Design is proposing something unusual. Instead of guarding a quantum machine as proprietary hardware, they want to publish a full-stack trapped ion quantum computer design, hardware, control layers, and software under open licensing. According to reporting tied to the University of Waterloo ecosystem, the goal is essentially a collaboration hub, a shared architecture other universities and labs can build on. Why this matters is less about who wins the quantum race tomorrow and more about how people train for it. If quantum becomes an open engineering platform, like Linux did for servers, it accelerates education, pipelines, tooling, and experimentation. The timing signal here is interesting. The discussion broke out on Hacker News this week, which rarely gives that much attention to quantum governance or architecture debates unless something is shifting.
Open source hardware for quantum. That's a pretty radical idea.
It is. And it's a reminder that sometimes the infrastructure stories start in developer forums before they show up in policy papers. Which brings us to a very different kind of infrastructure, medicine. Flash radiotherapy has been floating around academic journals for years as a bold idea. Deliver radiation at ultra-high dose rates in extremely short bursts with the hope that tumors die but surrounding tissue survives. According to a fresh piece in IEEE Spectrum, published March 6th, the conversation has shifted from theory to engineering reality. The practical question now is not, can it work, but can hospitals actually build and run the machines? That means beam control, dosimetry, safety protocols, and clinical workflows. The implication is that if flash becomes viable, the real winners may not be pharmaceutical companies, but hardware manufacturers and medical device engineers. The reason it surfaced this week is simply that new coverage tends to follow real technical milestones when feasibility starts looking operational. And interestingly, that same theme, hardware quietly evolving under the surface, shows up again in computing. ARM's new Cortex-X925 core is drawing serious attention in technical circles. A teardown circulating this week argues that ARM's mobile lineage is now aiming directly at desktop-class performance. Developers are debating the design details, front-end pipelines, back-end execution, and comparing it to contemporary x86 chips. But the deeper story is ecosystem stress. If ARM processors keep moving into high-performance computing territory, software assumptions break. Memory models differ. Tool chains behave differently. Engineers suddenly discover that code optimized for one architecture behaves strangely on another. The thread gained hundreds of comments on Hacker News this week, which is usually the sign that a hardware shift has reached developer consciousness.
So the architecture wars never really end.
They just change layers, and sometimes they change interfaces. That's exactly what another breakout topic this week suggests. A tool called Key Editor is experimenting with something unusual, editing code not as text, but as a structured tree. Instead of typing characters into a file, you manipulate the program's abstract syntax tree, the internal structure the compiler actually sees. The concept has existed for years in research environments, but the sudden burst of developer interest suggests a moment of reconsideration. If AI is generating more code, developers may want tools that enforce structural correctness rather than trusting text alone. The Hacker News post climbed rapidly in its first few hours, which is usually how niche tooling ideas signal a deeper frustration developers are trying to solve. And that frustration, AI systems behaving unpredictably, shows up in the next story as well. A startup called Sakura launched this week pitching a simple premise: testing and monitoring for AI agents. Instead of traditional QA, they simulate conversations and sessions to detect regressions or weird behaviors. That pitch reflects a broader operational reality. When AI agents fail, they don't just crash, they hallucinate, they drift, they behave inconsistently depending on context. According to the founder's description, manual QA simply doesn't scale for these systems. The post didn't dominate the site, but it attracted enough traction to suggest that reliability is turning into a real product category.
So the industry built the agents first, and now they're building the safety rails.
Exactly. And the next story shows why those rails might be necessary. India's Supreme Court issued a warning this week about something that would have sounded absurd a few years ago: legal rulings citing cases that don't exist. The court cautioned that relying on AI-generated, fabricated precedents could amount to professional misconduct. The same pattern is appearing in journalism. A newsroom correction earlier this year acknowledged fabricated quotations produced by AI tools, which then circulated through industry discussions about editorial standards. The second-order consequence is that credibility systems, law, journalism, scholarship, may need entirely new verification layers. And that credibility problem shows up again in an unexpected place: wearable technology. Meta's Ray-Ban smart glasses became the subject of scrutiny after reports that contractors were reviewing sensitive video captured by the devices. Some of that review work reportedly took place outside the countries where the glasses were used. Regulators, including the UK's Data Protection Authority, began asking questions. The important detail is the assumption many users had that footage processed by AI stays local. In reality, complex systems often rely on human review pipelines. The reason this surfaced now is simply that recent reporting and discussion threads brought the practice into the open. Which leads naturally to another layer of the digital ecosystem that quietly shapes everything else: search. Google recently completed a Discover-only core update, something unusual because it targeted the Discover feed rather than traditional search results. At the same time, ranking volatility trackers have shown unusually high turbulence heading into March. And there's another wrinkle. Analyses summarized by SEO researchers suggest that AI-generated answers are increasingly citing sources that aren't even in the top 10 search results, sometimes not even in the top 100. Meanwhile, YouTube appears to dominate citation patterns in AI answers. The implication is that visibility online may no longer depend entirely on ranking first. It may depend on being machine interpretable.
So the attention economy now has two audiences:
Humans and algorithms. And algorithms, as it turns out, are learning tricks from attackers as well. A cybersecurity report published March 6th describes a campaign linked to the group Transparent Tribe that used AI tools to mass-produce malware implants targeting India. The novelty isn't just phishing emails, it's automation in generating the malicious code itself. The implication is straightforward. If AI accelerates development cycles for legitimate software, it can accelerate attack cycles too. That's why cybersecurity analysts flagged the report this week as an inflection point rather than just another incident. But technological signals aren't the only ones worth watching. Sometimes the most revealing indicators come from ordinary behavior. Searches for the phrase "can't sell house" have spiked recently, according to coverage analyzing Google query trends. The timing coincides with housing market data showing sellers significantly outnumbering buyers in the United States. Search queries are often emotional telemetry. People type what they're worried about. When that anxiety appears before official statistics move, it can act as an early signal of stress in a market. In this case, the concern revolves around liquidity, houses sitting unsold while mortgage rates remain high. Now shift from personal economics to institutional finance. On March 5th, U.S. banking regulators issued guidance clarifying how tokenized securities should be treated under capital rules. The key message was simple. If a security is tokenized but otherwise identical, banks should treat it the same for regulatory purposes. That might sound technical, but it's an important threshold. Once regulators publish FAQs about something, banks start building processes around it. The bottleneck moves from legal uncertainty to operational infrastructure, custody systems, auditing frameworks, and settlement pipelines. That same link between geopolitics and infrastructure shows up in the stock market in smaller ways too. A microcap company called Peraso announced that its millimeter wave technology had been selected for a drone identification system designed for contested electronic warfare environments. Around the same time, the stock suddenly appeared on unusual volume lists. This doesn't mean the company will succeed, but it illustrates a pattern. Military technology narratives often leak into small-cap trading activity long before they appear in large-cap defense indexes. And the idea of owning your distribution is leaking into sports media as well. NASCAR recently launched a newsletter presence on Substack, part of a broader experiment with direct-to-audience publishing. According to Axios reporting and discussions among newsletter operators, the move reflects a growing desire to convert audience attention into direct subscriptions rather than relying entirely on social platforms. The reason it popped this week is that creators themselves are discussing tactics, bundling paid tiers and live video formats in public forums. That's often when a structural shift becomes visible. Now for something completely different: potatoes. In the United Kingdom, loaded jacket potatoes are staging a comeback. Vendors like Spud Bros have accumulated huge view counts on social platforms while expanding their physical locations. Reporting in The Guardian and recent business profiles frame it as a viral comfort food revival. The economic angle is straightforward. In periods of high living costs, inexpensive, customizable meals become ideal trend vessels. They're cheap, photogenic, and adaptable to social media formats.
Once again, our cousins across the pond find a way to make baked potatoes posh.
And finally, the weird internet artifact of the week. Someone rebuilt the classic dependency comic as an interactive physics simulation using P5.js. The original cartoon showed the software stack as a precarious tower of blocks. In this version, you can watch the tower wobble, collapse, and rebalance. It exploded on Hacker News, over 1,000 points, because it does something rare. It turns developer humor into a teaching tool. You can literally see how fragile modern software dependencies are.
So the joke became the lesson.
In a way, yes. Because across all these stories, from quantum computing to potatoes, you can see a few patterns forming. First, infrastructure is shifting quietly. Quantum hardware, chip architectures, medical devices, and regulatory frameworks are all evolving under the surface. Second, AI is entering its operational phase. The conversation isn't just about building systems. It's about verifying them, regulating them, and defending against them. And third, attention itself is fragmenting. Search algorithms, newsletters, social media, and niche communities are each creating their own discovery channels. Individually, none of these stories dominated the headlines this week. But together, they sketch the map of where things might go next. Now let's wake up ready. We begin with orientation. Where are we in the cycle right now? The global system looks like it's entering a late disinflation slowdown. Inflation has cooled substantially from the peaks of the past few years, but the economy isn't collapsing either. Instead, the system is shifting posture. Central banks are no longer easing aggressively. The Federal Reserve has paused policy in the mid 3% range and is signaling patience. That pause tells you something important. The emergency phase of inflation fighting is over, but policymakers are not confident enough to declare victory. At the same time, the real economy is beginning to show small cracks. Payroll growth recently turned negative, unemployment has drifted into the mid 4% range, participation has softened slightly. Yet the services economy is still expanding, and business activity remains strong. So the system is sitting in a narrow corridor. Growth is slowing but not collapsing. Inflation is cooling but not defeated. Liquidity still exists, but it is becoming selective. That's the structural phase we're navigating this week.
Which makes it a strange moment for markets. You can point to labor and say slowdown, but you can point to services activity and say expansion.
Exactly. The system is drifting between two narratives. Underneath the surface, several structural forces are already moving. Labor is softening. Hiring momentum has slowed across sectors. Employers appear to be entering what economists call a low-hire, low-fire regime. Quits and hiring rates have fallen, but layoffs remain contained. That tends to produce stable but uninspiring growth. Monetary policy has shifted into a wait-and-see posture. The Fed isn't eager to cut quickly because inflation expectations haven't fully relaxed, and energy prices are beginning to rise again. Meanwhile, fiscal expansion continues. The U.S. deficit is drifting toward roughly $2 trillion this year, which means the Treasury must keep issuing enormous amounts of debt. That steady supply puts a floor under long-term yields. At the same time, a very different force is reshaping the corporate landscape. The AI infrastructure cycle is accelerating. Hyperscalers are projected to spend somewhere in the range of $500 to $650 billion on AI-related capex this year. Data centers, semiconductor capacity, and energy infrastructure are all expanding rapidly. So capital is becoming concentrated. Some parts of the economy are tightening, while others are investing at generational scale. And then there's energy. Oil prices have been rising again amid geopolitical tension and shipping risk in the Middle East. Put all that together, and the system begins to look like a slow drift toward weaker growth, but with persistent inflation pressure and massive strategic investment.
So liquidity hasn't disappeared, it's just flowing into very specific places.
No, capital is still available, but it's becoming more selective. Balance sheet strength, infrastructure, and strategic technology are attracting investment. Everything else is facing more scrutiny. Now, let's talk about the events that will test that trajectory this week. The first major checkpoint arrives with the CPI report. That comes out midweek, and it's the most important inflation data before the Fed meeting. What markets want to know is whether disinflation is still intact or whether tariffs and energy are starting to creep back into the numbers. If CPI comes in cooler, it reinforces the idea that inflation is gradually falling and gives the Fed room to eventually ease policy. If it comes in hot, it strengthens the argument that inflation may be stuck closer to 3% than 2%. And that matters enormously for markets. Front-end treasury yields, the dollar, growth stocks, consumer discretionary names, they all react to that number. Shortly after that, we get a deeper look at the consumer through the personal income and spending data. That release includes the PCE inflation composition, which is the Fed's preferred inflation gauge. The question there is whether household income is still cushioning demand. Payroll weakness by itself doesn't break the economy, but if income growth and spending begin to roll over at the same time, the slowdown becomes much more serious.
So CPI tells you the inflation story, and income tells you whether the consumer still has fuel.
Yes, and then we move into the technology narrative. NVIDIA's GTC conference takes place over several days in San Jose. This event has become something of a checkpoint for the AI infrastructure boom. Investors will be listening closely for signals about whether the capex cycle is still expanding into real enterprise demand, or whether it's becoming a crowded infrastructure trade. Right now, hyperscalers are spending at historic levels, but investors are beginning to ask when those investments translate into measurable productivity and profits. From there, we arrive at the most important policy moment of the month, the Federal Reserve meeting. The Fed concludes its meeting with a press conference from Chair Powell. Policymakers are now facing a tricky combination: weaker labor data alongside rising energy prices. Markets will be watching closely to see which risk the Fed emphasizes. Is the slowdown in employment the bigger story, or does the committee remain focused on inflation persistence? The answer affects the entire financial system: the yield curve, equities, credit spreads, mortgage rates, and the dollar. And then we have an important international dimension. The Bank of Japan also meets around the same time. Japan has been gradually stepping away from ultra-loose policy, but global volatility and currency pressure complicate that process. If the BOJ signals further tightening, it could change global liquidity dynamics because Japanese capital flows influence bond markets worldwide. On top of all that, we also get the Producer Price Index. PPI measures pipeline inflation, the cost pressures moving through supply chains. The previous report showed some firmness, so another strong reading would suggest inflation pressures may still be building beneath the surface.
So the week isn't really about a single data point. It's about whether the inflation story, the consumer story, and the AI investment story still hold together at the same time.
Right. Now let's talk about the fragile parts of the system. One of them is the Treasury market. The U.S. government is issuing enormous amounts of debt to finance deficits. As long as investors absorb that supply, yields remain manageable. But each auction quietly tests that assumption. If demand weakens, if bid-to-cover ratios fall or yields spike, long-term borrowing costs could rise quickly. Another fragile point is credit markets. Investment-grade spreads are extremely tight, hovering around multi-decade lows. That means markets are essentially pricing a very smooth economic outcome. If growth disappoints or defaults begin to rise, spreads could widen rapidly. And then there's energy. Oil has already been climbing. If crude moves and holds above $100 a barrel, it would push inflation back into the macro conversation very quickly.
Which is the nightmare combination for policymakers: slower growth and higher inflation.
Exactly. So what would tell us that the trajectory has actually changed? In the bond market, it would be persistent weakness in treasury auctions and a sustained rise in long-term yields. In credit, it would be spreads widening sharply as lenders demand more compensation for risk. In the labor market, it would be several consecutive months of job losses and unemployment approaching 5%. And in energy, it would be oil moving to and then staying above the $100 level long enough to feed through to transportation, manufacturing, and consumer prices. Those are the signals that would turn a slow drift into a structural shift.
So the system isn't breaking, but there are a few pressure gauges everyone should be watching.
And that brings us to the shadow calendar, the things that influence markets even when they're not making headlines. Treasury issuance schedules matter because they determine when the market must absorb large amounts of government debt. Technology investor events and conferences influence expectations about the scale and timing of AI investment. Corporate refinancing calendars matter as well. Many companies need to roll over debt this year, and their ability to do so depends on credit markets remaining open. And finally, there's geopolitics. Energy markets can move quickly if tensions escalate or shipping routes become constrained. So the hidden layer of this week is the interaction between routine events and structural pressure. The system is slowing, inflation risks haven't disappeared, capital is becoming more selective. The next few data releases, policy signals, and investment checkpoints will tell us whether that drift continues or whether one of those pressure points begins to move. That's the map for the week, and that's how you wake up ready.
All right, here's a knowledge bomb that sounds like it came from Wall Street but actually came from Scripture. If you spend enough time studying investing, you eventually hear the same rule repeated everywhere. Diversify. Don't put all your eggs in one basket. Spread your risk across assets, time horizons, and opportunities. Modern finance treats that idea as if it's a clever discovery of economists and portfolio managers. But here's the twist. The world's major religions figured this out thousands of years ago. Buried inside ancient texts is what might be the oldest portfolio strategy ever written. In the book of Ecclesiastes, you find a line that reads, "Invest in 7 ventures, yes, in 8, because you do not know what disaster may come upon the land." 7 or 8 ventures. That's not poetry, that's diversification. The logic is the same one any risk manager would give you today. The future is uncertain, so spread your exposure. Judaism made the advice even more explicit. The Talmud recommends dividing wealth into 3 parts, 1/3 in land, 1/3 in business, and 1/3 kept liquid. Real assets for stability, enterprise for growth, and cash for flexibility. It's essentially a 1,000-year-old asset allocation model. Islam framed the idea through risk management. A famous saying of the Prophet Muhammad tells a believer who wanted to rely on faith alone, "Tie your camel, then trust in God." In other words, do the prudent thing first. Secure the asset, manage the risk, then accept the uncertainty of the outcome. Faith is not a substitute for preparation. In Buddhism, the Buddha offered what might be history's earliest household budgeting rule. Divide income into 4 parts, 1 for living expenses, 2 reinvested into productive work, and 1 saved for emergencies. Spending, investing, saving, liquidity. A complete financial system delivered as moral instruction. And across traditions, you see the same final piece of the portfolio, charity. They each call it something different, but these systems required believers to give a portion of their wealth away, not only as compassion, but as a kind of social diversification. Your prosperity becomes embedded in your community, reducing the risk that misfortune isolates you completely. So when you zoom out, the pattern becomes clear. Ancient faith traditions understood something modern finance only rediscovered centuries later. Life itself is volatile. Harvests fail, kingdoms collapse, markets crash, health changes, luck turns. And the moral response to uncertainty was always the same: prudence, preparation, and diversification. In other words, the first portfolio managers weren't economists. They were sages. And the original investment advice was simple. Tie your camel, then tie it to 7 different posts.
I think we need a new category of financial risk. Not market risk, not interest rate risk, not geopolitical risk. I'm talking about AI confidence risk. Humor me, because we've reached this strange moment where a machine gives you an answer, and it's so smooth, so polished, so eerily reasonable that your brain just quietly folds its arms and says, "Well, that sounds right." Scholars now call this lucent surrender, when the glow of a plausible answer extinguishes the instinct to verify. Which is fascinating, because historically, humans only surrendered their judgment under 3 conditions: authority, alcohol, or PowerPoint. Now, apparently, we'll also do it for a well-formatted paragraph. The related emotional state is something called veridread. That's the moment when an AI gives you an answer that seems brilliant, maybe even magical, and you feel 2 emotions simultaneously. The first is wow. The second is, I have absolutely no idea if that's correct. It's like when someone confidently explains blockchain at a dinner party. You nod politely, but internally you're thinking, if I asked one follow-up question, this whole story might collapse. And the dangerous thing about veridread is that the more confident the answer sounds, the less we check it. Which means AI has accidentally discovered the most powerful management technique in history: confidence. Imagine if humans had always worked this way. A pilot lands the plane and says, "Good news, everyone. I'm about 85% sure that was the runway." Or a surgeon says, "Don't worry, I asked an algorithm." But in finance, we already do this constantly. Analysts build models with 12 tabs, 6 discount rates, and a sensitivity table that looks like a chessboard. And everyone nods because the spreadsheet is color-coded. Green cells mean optimism. Red cells mean concern. And somewhere in the middle is the quiet truth that nobody has the faintest idea what copper prices will be in 2031. Which leads to my favorite emerging career skill: not coding, not prompt engineering, but confidently reading things you don't fully understand. In fact, if this trend continues, we may need a new professional designation. The CFA will stand for Certified Fact Avoider. Level 1, learn the vocabulary. Level 2, trust the model. Level 3, never ask where the data came from. And to be fair, markets have always had a little lucent surrender built in. Every cycle starts the same way. Someone produces a convincing narrative. Everyone agrees it sounds sophisticated. Capital flows enthusiastically. And then 3 years later, we call it a learning experience. So maybe the real lesson isn't about AI at all. Maybe it's just a reminder that the most dangerous words in finance have never been risk-off. They're still the same ones we've always trusted a little too easily. That seems reasonable.
And now for the greater debate. There are debates that fill auditoriums, and there are debates that clear dinner tables. This one does the latter, because the question sounds simple, almost mechanical, but the implications reach into the psychology of markets, the memory of crashes, and the uncomfortable truth that every financial system is built on some mixture of courage and delusion. The question tonight: should investors be allowed to borrow money to buy stocks? Or, more precisely, does leverage make markets stronger, or does it quietly turn prosperity into Kindle? Picture the setting: a wood-paneled faculty lounge in the middle of the 20th century. The Great Crash is no longer fresh, but it is not yet history. It lingers in conversation the way a house fire lingers in the smell of the walls. Coffee cups, ashtrays, a chalkboard with half-erased equations, 2 lecterns. At the first stands John Kenneth Galbraith, economist, historian of financial folly, and a man whose wit can slice a theory cleanly in half. He carries the memory of 1929 like a cautionary parable. At the second stands Joseph Williams, the man who made credit cards accepted and plausible advocate of financial margin, the sort of market practitioner who believes deeply that capitalism works best when ambition is given tools rather than restraints. The room settles. Williams begins. He speaks calmly, almost conversationally. The argument, he says, begins with arithmetic. Capital is scarce. Opportunity is abundant. Margin, the ability to borrow part of the purchase price of an investment, bridges the two. Consider the ordinary investor, a man with $5,000 saved after years of careful work. Without leverage, that man participates in the economy only in proportion to his savings. But with margin, say 50%, his capital becomes $10,000 of productive ownership. He can hold more companies, participate in more growth, diversify more widely. Margin, Williams says, is not a casino chip. It is capital efficiency. He gestures toward the broader economy. The 20th century did not grow through caution alone. Railroads were financed with debt. Factories were financed with debt. Entire industrial empires were financed with borrowed money because borrowing allows society to pull future productivity into the present. Why should equity investors be the only participants forbidden from that tool? There's a murmur in the room. Williams presses the point. Leverage, he argues, does something markets desperately need: liquidity. When investors can use margin, more capital enters the market. Trading volume rises. Prices adjust more smoothly. New companies can raise capital because the market is deep enough to absorb shares. He points to the late 1920s not as evidence of madness, but as evidence of scale. Broker loans surged into the billions. Foreign capital flowed into Wall Street because returns were strong. The American market became the financial center of the world. Remove margin, he suggests, and markets become thin ponds instead of deep lakes. Prices swing wildly because there simply isn't enough capital participating. He pauses, then delivers the line that clearly lands. Without leverage, America risks becoming a nation of savers rather than builders. A few heads nod. Galbraith leans forward. When he speaks, the tone is gentle, but the knife is visible. He says Williams is correct about one thing. Margin multiplies capital. But what it multiplies, he says, is not wealth. It multiplies belief. Galbraith asks the audience to remember what actually happened in the years before the crash. Margin accounts allowed investors to control large portfolios with relatively small cash commitments. That meant a rising market created the illusion of universal brilliance. Investors doubled their exposure with borrowed money. Rising prices justified more borrowing, which pushed prices higher still. The market appeared thick and healthy, he says, the way a river appears powerful just before the dam breaks. Then he describes the hidden fragility. Margin debt is stable only while prices rise. The moment prices fall, the structure reverses. Brokers demand more cash. Investors scramble to sell assets to meet the call. Those sales push prices lower, which triggers more calls, which triggers more selling. What looked like liquidity becomes a cascade. Galbraith delivers the metaphor with surgical calm. A man standing on a ladder made of glass may feel tall, right until the first crack. The room goes quiet. Williams doesn't retreat. He smiles slightly, the way a practitioner does when theory sounds elegant but incomplete. He concedes the historical point. Yes, leverage magnifies losses. Yes, margin calls can accelerate downturns. But blaming margin for the crash, he argues, confuses a tool with the mood of an era. Markets collapse when people abandon discipline. Margin did not invent speculation. Speculation invented the misuse of margin. He shifts the focus to policy. If the Federal Reserve manages credit responsibly, if margin requirements are reasonable, leverage becomes manageable risk rather than systemic fragility. Investors know the rules. They understand the danger. The market prices it accordingly. He compares margin to a hammer. A hammer can build a house. It can also hit a thumb. The existence of the tool does not require banning carpentry. The room laughs lightly. Williams then lands his strongest argument. Risk, he says, is the price of growth. The American economy thrives precisely because individuals are willing to take calculated risks with borrowed capital. If every investor were forced to operate strictly within cash savings, innovation slows, ownership concentrates, and economic mobility shrinks. In other words, eliminating leverage may reduce crashes, but it may also reduce progress. Galbraith listens carefully. When he responds, he does not dispute the ambition behind the argument. Instead, he challenges the assumption buried inside it, the assumption that investors remain rational. Galbraith says financial history shows the opposite. In speculative booms, common sense is not stable. It erodes. Prices rising today convince investors they will rise tomorrow. Borrowed money makes the optimism irresistible because the gains appear larger and faster. Margin, he argues, does not merely facilitate speculation. It incentivizes it. He points out that during the late 1920s, investors were not performing careful analysis of industrial productivity. They were chasing momentum. Newspapers celebrated overnight fortunes. Taxi drivers offered stock tips. Borrowed money poured into shares not because valuations made sense, but because the crowd believed the market had discovered a new law of gravity. And when belief becomes the asset, leverage becomes gasoline. A few people shift in their chairs. Williams answers without defensiveness. In fact, he acknowledges something unexpected. He admits that Galbraith's critique of psychology is correct. Financial memory is short. Investors routinely underestimate risk during good times. But he turns the admission into a pivot. If human optimism cannot be eliminated, the answer cannot be to remove every mechanism that amplifies it. Society depends on individuals willing to extend themselves, to start companies, to invest ahead of certainty, to build infrastructure before profits are guaranteed. Leverage is simply the financial expression of that human trait. Without it, he says quietly, economies become careful but stagnant. Galbraith nods slowly, and then he offers his own moment of honesty. He admits that eliminating leverage entirely might indeed make markets too rigid. Some borrowing is necessary for capital formation. Some speculation is unavoidable. But the lesson of crashes, he says, is that systems built on borrowed confidence eventually collide with arithmetic. The challenge is not ambition. The challenge is remembering that gravity exists. The room sits in thoughtful silence. Two visions of capitalism hang in the air. One sees leverage as a ladder, dangerous perhaps, but necessary to climb higher. The other sees it as a fuse, quiet, invisible, and eventually burning toward something explosive. If you listen closely, what makes this debate linger isn't that one side is obviously right. It's that both are describing something real about markets. Ambition builds economies, but belief, when multiplied by borrowed money, has a long record of turning prosperity into instability. History, of course, has been kind enough to show us both outcomes. And that is the greater debate.
Let's invent again. Innovation rarely begins in a gleaming lab. More often it starts somewhere humbler, somewhere a little ridiculous in hindsight. In the winter of 1961, in a modest apartment in Prague, a chemist sat at his kitchen table, assembling what looked less like scientific equipment and more like the aftermath of a child's birthday. There was an old phonograph turntable, pieces of a metal erector set, a few wires, some molds. His wife watched nearby, occasionally offering medical insight. This was not supposed to be the birthplace of a global medical device. The chemist was Otto Wichterle, a polymer scientist who had spent the previous decade chasing an idea that sounded deceptively simple. What if contact lenses didn't feel like rocks in your eye? At the time, contact lenses already existed, but they were essentially tiny pieces of glass or rigid plastic. Imagine placing a polished button on the surface of your eye and hoping your eyelid would politely cooperate. They were uncomfortable, expensive, and required weeks of painful adjustment. Many patients simply couldn't tolerate them. The basic problem was material science. The human eye is a wet, delicate surface. Hard materials slide across it like ice on sandpaper. If contact lenses were ever going to become mainstream, they needed to behave less like plastic and more like living tissue. Wichterle believed the answer was a hydrogel. In the 1950s, he had synthesized a polymer called hydroxyethyl methacrylate, or HEMA. When mixed correctly, HEMA absorbed water and became soft, transparent, and flexible. It was essentially a water-filled plastic sponge. To a chemist, that property was fascinating. To a doctor, it was obvious what it might mean. A material that holds water and stays clear is exactly what you want touching the surface of an eye. But materials alone don't make products. The harder problem was manufacturing. You can invent a miraculous substance, but if you can't shape it precisely, reproducibly, and cheaply, the idea never leaves the lab. Early attempts to mold hydrogel lenses produced irregular shapes that distorted vision. The lenses warped, collapsed, or stuck to their molds. This is where Wichterle's story turns from chemistry into improvisation. In 1960, a political purge in communist Czechoslovakia forced him out of his academic position at the Prague Institute of Chemical Technology. He lost his lab, his funding, and his institutional support overnight. For most scientists, that would have been the end of the project. Instead, it forced the invention out of the lab and into the kitchen. At home, surrounded by household objects and a stubborn curiosity, Wichterle started experimenting with a new idea. What if the lens didn't need to be molded in its final shape? What if centrifugal force could form it naturally? Imagine a droplet spinning in a rotating bowl. Surface tension pulls it into a perfect curve. Wichterle realized that if a liquid polymer rotated at the right speed while it polymerized, the forces of motion and gravity would sculpt the lens automatically. This is where the phonograph enters the story. He mounted molds onto the spinning plate of an old record player. He used parts from an erector set to build a rotating assembly. As the machine spun, liquid HEMA polymerized into thin, curved lenses shaped by centrifugal force. It looked absurd, but it worked. The process became known as spin casting, and it solved 3 problems simultaneously. It produced perfectly curved lenses, it eliminated complex machining, and it made manufacturing scalable. Within 5 months, Otto and his wife produced more than 5,500 lenses on their improvised device. If you're listening to this story through the lens of modern startups, it has all the familiar beats. A breakthrough material, a clever manufacturing insight, a scrappy prototype built from whatever parts were available, a founder working outside the institutional system. But the ending is less Silicon Valley and more Cold War bureaucracy. Because Wichterle lived behind the Iron Curtain, the Czech government owned the patent rights to his process. He personally earned almost nothing from the invention. In 1966, the rights to the technology eventually made their way to the American company Bausch & Lomb for about $3 million. The company refined the manufacturing process and brought soft contact lenses to global markets. Today, more than 100 million people wear contact lenses. For many, they're so normal they barely register as technology. Just a small transparent disc you place on your eye each morning. But that everyday convenience hides a deeper shift. Soft contact lenses didn't just improve vision correction, they fundamentally changed the economics and adoption curve of the entire category. Hard lenses required tolerance and patience. Soft lenses required almost none. The adjustment period dropped from weeks to hours. Comfort improved dramatically. Manufacturing costs fell. Suddenly, contact lenses moved from niche medical device to mainstream consumer product. This pattern shows up again and again in the history of invention. The breakthrough isn't always the core idea. Sometimes the breakthrough is removing the friction that keeps normal people from using the idea. Think about what smartphones did for the internet. The internet existed long before the iPhone, but navigating it through desktop computers kept it tethered to desks and offices. Touchscreens and mobile hardware removed the friction, and suddenly the entire planet was online. Or look at modern AI tools. The underlying models are remarkable, but the real adoption surge happened when someone wrapped them in interfaces ordinary people could actually use. In that sense, Wichterle's true innovation wasn't just a softer lens. It was designing a technology that aligned with the human body and with mass manufacturing at the same time. That alignment is the hidden engine of successful inventions. Brilliant ideas fail constantly because they require too much behavior change, too much infrastructure, or too much tolerance from the user. The winning inventions quietly reshape themselves around human reality. And there's another lesson here that founders and investors sometimes overlook. Innovation often accelerates when constraints increase. If Wichterle had remained comfortably employed in a well-funded academic lab, he might have continued refining traditional molds for years. The political purge that forced him out removed his resources, but also removed the inertia of institutional thinking. Suddenly, he was building prototypes with household tools. Suddenly, the solution had to be simple enough to assemble on a kitchen table. Constraints compress creativity. They strip away complexity and force the inventor to find the shortest path between idea and reality. A phonograph turntable and an erector set are not what most people imagine when they picture medical innovation, but they embody something important about how progress actually happens. The future is rarely built entirely in pristine labs. It's assembled in garages, kitchens, dorm rooms, and improvised workshops by people who refuse to wait for perfect conditions. Otto Wichterle never became wealthy from his invention. The economic rewards flowed elsewhere. But his insight reshaped how millions of people experience their daily lives. And the deeper pattern still echoes today. The most powerful innovations aren't always the ones with the most sophisticated technology. They're the ones that quietly eliminate friction between a human need and a practical solution. When that happens, adoption stops being a battle. It becomes inevitable. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc, from signals to systems, from pressure to practice, from clever stories to hard structure. The pattern was simple. Progress rewards prudence, scale tests stability, and every durable breakthrough begins by reducing friction before it earns belief. In markets, in machines, in daily life, the first principles still hold. Patience matters, preparation matters, and what lasts is what finally fits.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious
Stay kind.
and keep compounding.